And 3, 2, 1.
Okay.
Welcome to the show.
Welcome to the show. A new month.
New year, new month.
New year, yep.
I still don't feel like it's 2023 yet. My brain hasn't caught up.
You know, ordinarily it takes me more than a month to get used to writing the new number at the end of the year, and somehow I've managed to put 2022 behind me, and I'm
2023.
Yeah.
Do you remember back in the old days? It was like you keep writing checks with last year.
Yeah.
Nobody writes checks anymore.
Right.
But we do a lot of saving files with the date.
Right.
And that's where. Yeah. I've done a couple wrong. Actually, I think I put up it might have been one of the January shows had 22. I don't know if anybody caught it, but I went in and changed it.
Yeah, I do sometimes make those kind of mistakes.
What do you got for us this week, man?
Dude, crazy week in the market. Honestly, I got to stop watching Bloomberg because as much as I like to feel like I know what's going on, the more supposedly I know what's going on, the more complicated it gets trying to manage TSP, right? We were talking about it this morning. The Meta, Facebook, right, comes out on, I guess it was Wednesday with earnings were bad, but they got more subscribers than they expected, so that was a positive. And then they said they were going to lay workers off and get more streamlined and efficient, and apparently the market liked that. So Meta has taken off in the last couple of days, and it pulled the NASDAQ up with it. So, everybody's really enjoying this rally in the S fund particularly, but the C fund also. And then the Fed comes out yesterday, was not as hawkish as people expected. And so the market kept moving higher. And last night, Amazon, Apple, I think, Google, Starbucks, Ford. So it wasn't all tech, but it was a lot of the big high-tech names came out. And earnings were horrible. At some point, at like 8 o'clock last night, Amazon was down 5%. I don't know what it is, right now. The market's down a little bit today. This is like, Friday morning we're doing this. So probably Friday's going to end on a down day, but it's been a heck of the last couple of weeks. And it's not collapsing. I mean, we can have a down day. That's fine. You have to have down days. Every day doesn't go up. But so far today, it looks pretty orderly, and that's fine. But the people on Bloomberg this morning were flipping out because the expected employment numbers were supposed to be like 187,000 new jobs created, and it turned out to be like 525,000. It was so far off, and
they didn't have talking points ready for that.
They did not, and they were like deer in the headlights. It was hysterical. 8:30 in the morning, it comes across the thing, and they're all like, because you got to justify it, right? And if it's 5x off where you thought it was going to be, how are you going to justify that?
Yeah, last night they went to bed with all their talking points going, all right, if it comes out a little bit, and all of a sudden it comes out like 5 times what it's supposed to. Yeah. That screwed up your talking points.
Yeah, for sure. But they, they're professionals. They just rolled right along with it and kept on going. I'm like, oh, I get it. Yeah. I get it. You're going to justify no matter what it is.
Yeah.
So at any rate, we're not going to talk about it anymore about that. Okay. February 5th. So we are, one more thing I want to talk about that's not going to be in the show is the January effect. So January is over. We did a whole write-up in the email. So if you're not on our email list, you don't have to subscribe to the site to be on the email list. So go to growmytsp.com. The little box will come up, put your email in there, and you'll get the emails that we put out every week. This week we're talking about the January effect, and which it's 3 pieces to it, right? Santa Claus rally, the first 5 trading days of January, and the closing price for January. So this year, all 3 of those were positive, and I broke down the whole thing from the Stock Traders Almanac, who is the guys that put the stuff out. But the bottom line is when the January effect is positive, that year you're going into, so this year for us is positive like 99% of the time. I mean, almost always, as 100% as you're going to get in any of this. This year should be statistically positive by like 25%. I mean, by a pretty significant amount. So definitely check out that email. It kind of breaks it all down in there, and how we kind of use that information to guide us going forward. I mean, I'm not, just because the January trifecta came out positive doesn't mean I'm going to, CNS and call it a day for the year. It's just not. It gives us a good bias.
It's not what we do.
No, it's not.
It's not what we do.
It gives us a good bias.
Yeah.
I might give it an extra day on the bullish side as I'm looking at it and making reallocation decisions. I might let it come down to a support level, and if it breaks that support level a little bit, rather than selling it then, if we're in a bear market, because in a bear market you should expect it's going to go lower. If all the tailwinds are behind you, then you might give it an extra day, expect with a bias to the upside, right? So that's kind of how we look at it. All right. So got a really cool Facebook post or message last week. Wanted to thank you guys for service, great educational products. Been a member for a few months and learned a lot about technical analysis. As for future topics, because we always say we appreciate you guys giving us some things that you want to see us write about and talk about. Have a couple things to consider. Would enjoy learning more about any tips you have about drawing resistance and support lines as well as trend lines. For example, do you draw them from wick to wick, candle body to candle body, opening to closing level? As you know, there are many types of charts. He's right. We use candle charts. Wondering what the pros and cons are relative to other popular chart types. For example, he's been using Elder Impulse System, but maybe candle charts are better for reasons that I don't know. So we're going to look at all those things this week in the podcast. So start with support and resistance and trend lines, right? Because it's really the basics of what we look at on the price chart. And then we're going to look at candlesticks. That's where he's talking about the wicks. We talked about that a couple of weeks ago, but we'll kind of go over that again a little bit. And then look at line charts and see what the difference is between line charts and candlesticks. And then I'm going to show what that Elder Impulse System is. It's actually a system as opposed to a chart type. It's in the chart type drop down in stock charts, but it's really more of a trading system. And I'm going to kind of show you guys that. And then the TSP fund charts. Okay. So support and resistance and trend lines. Support and resistance is what you're looking for, right? You want to see price come down and find support or go up and hit resistance. And it can find support and or resistance at moving average lines or trend lines. So we'll start off with moving average lines, right? This is a monthly chart. Okay, so each one of these ticks is 1 month of price movement. Okay, we have the 50-month moving average line in blue, and we're going back to 1990. Okay, so if you're a super long-term investor, you don't want to spend much time looking at your TSP account, going back to 1990, if you had been in the stock funds above that blue line, right, from 1990 to 2001, you were in the market. When it crossed that blue line, we had about a 50% decline from where price crossed that blue line. Can't really kind of see it back here, but every time price kind of consolidated and came down to that blue line and found support there, right? So that moving average line acted as support for years in the first part of the 90s. Once it broke after the top in 2000, right here, it became resistance, right? It came up, couldn't get above it, eventually bottomed out there in late 2002 and finally bottomed in early 2003. And then once it got above it, it stayed there till it rolled over and crossed there in 2008. Had another more than 50% loss from that point in 2008 into 2009. So they're guides.
And it's worth noting, right? We've talked about this before. If you only used that chart, that chart only, over the course of your 30-year career, you'd fare way better than folks that did the buy and hold, because you would miss those significant drops because you would see a clear trend change. So that's a good point, and I can already hear people arguing. So here's the idea. If you got out when the market broke down, you would have gotten in, theoretically, using this when the market got back above that line. Right.
and it's pretty much flat,
Mm-hmm.
right? So you didn't really, if you only used that, you wouldn't have gained and you wouldn't have lost.
Right. But again, we go back to the math where we've got that chart that shows that if you take this much loss, it takes this much to get back your account balance.
Right.
Your account balance.
Right.
That's what we worry about more than just that, right? So my account balance would not have gone down, but it will take the other person longer to get back.
Up. Yeah.
Which is especially in those large downturns. Those two large downturns have ruined many of retirement accounts. And we know this because we were in the Gov when that happened.
Yeah.
And so if you were out just for those 2 moments in time, you fared way better. And you probably just sat in the market from 12 to 22.
Yeah, right? For sure. I mean, the only overshoot there was COVID.
Yeah. And you would have been in and out.
Yeah.
No big deal. Not a big flash, but those two significant downturns, right? Those are the ones that, this methodology is meant to not take. Right.
The biggest, one of the things, if you were retiring, back here in 2000, and you took some losses, but then you got out when the market crossed that line and you moved to the G fund, you saved yourself from a 50% downturn that took a couple years, 2001 to 2004.
So you would not have been sitting there for years watching your account balance drain.
Right. And if you're retired and you're withdrawing, you're taking out of it. Yeah, it's horrible.
Yeah. And so some of this, again, methodology is built around just sleeping well at night. Mm-hmm. And so, sure, your account balance isn't going up during that time, but it's not going down unless you're withdrawing, and that's okay because at least you're not like withdraw and go down, and go down.
Right.
And so I think once people wrap their head around that piece of this, our thesis, our methodology, our process, it starts to really make sense. And you have to have been in the government or, whatever, when one of these things happened to see it. Yep. And so, fortunately, unfortunately, we've seen a couple. Yeah. 3.
Yeah, 3.
And so that's why we buy into the methodology so much because we've seen it. If you haven't seen it, if you're 25 years old and you just came in the government and you're listening to all this, you go, I don't know. But if you live through it, you go, hey, man, I'm in.
I mean, you just did live through it, 2022.
You did, but it wasn't years.
No, not yet.
Right.
I mean, you're in it.
You're in it right now. You know what's funny? Let's go back and look at that chart because you're right. Did you know what you were looking at there in early 2002? You probably didn't. Unless you were looking at the market like we do, right? You didn't know what you were looking at. And so you were kind of like, you were either head in the sand or you were, oh my God, the sky's, you didn't know what to do.
Right.
Because you didn't have a plan.
Right.
If you had a plan, and the plan was just as simple as this, and I know I'm kind of getting us off track, but I think it's important that people who kind of start going down this road of technical analysis, I think you're one of two type of people when you start kind of buying into technical analysis. You're either kind of the person like me who like appreciates all these things you can do, but I'm not going to do them, right? Because I got other things that I'm doing and interests and whatever and hobbies and whatever. I don't want to learn all of that. I want to learn enough that I can have a plan.
Yep.
And then you've got guys like you who really enjoy it and want to learn it to a level of, even if you're not going to use them, you're like, oh, let me just play around with this. And,
sure. Yeah.
It's more of like a hobby meshed in with like, something that's very useful. And so I think I've seen this with the people that join our site that become one of those kind of two people. They're like, I don't know if I want to go all in on all this stuff. But again, the good thing is you don't have to.
Right.
Now, are you going to fare as well as really actively managing it? Right. But when we say actively managing it, that could be weekly. It also could be monthly. And if you go here, this would be a monthly view. Right. This is a 50-month moving average. So that would literally mean you'd probably make a move once a month.
Oh, on this chart, if you only did it off the 50-month moving average, you're only making 1, 2, 3, 4
moves.
Probably moves in 30 years.
30 years, exactly. And you still would have fared better than people that didn't. So,
you certainly sleep better at night.
That was a long explanation to get to. You don't have to make it too complicated.
It doesn't.
Now, if you enjoy the complexity, there's a lot of things you can do.
Yeah. So that's the big long-term picture, right? For where each tick is a month and it's a 50-month moving average. So if you want to look at it a little more frequently, right? Now we got a 10-year chart and a 50-week moving average. So each one of these ticks is a week instead of a month. And we're looking at a 10-year chart, right? So it's a weekly chart. So the blue line is a 50-week moving average. So you can still see back here from 2013, we were already above that 50-week moving average. Did an intra-month, because that's a wick, did an intra-month, got below it, but it didn't close below it there. It didn't actually close below the 50-week moving average line until right there in 2015, right? So if you had gotten out there, you missed this whole like year's worth of downtrend into 2016.
Because you wouldn't have gotten back in there in the middle, because that's all just churn.
Right.
You wouldn't have gotten back in if you're really paying attention.
If you're paying attention to it,
right?
Yeah.
You'd say no. This is just churn. It's riding the line.
Yeah.
That's not a reason. If you're looking long term, big trends, that's not a big trend change.
Right.
Yeah.
Right.
So I just wanted to point that out in case people would have been like, oh no, you'd gotten back in and out.
I mean, you could, and those are the kinds of things that you work through as you're learning how to do this. I mean, it rode for a quarter right on that line, and then roll back over, right? So, but this is just one tool, just the 10-year weekly chart with one moving average line, and we always show RSI and MACD and CCI and trend lines and all this other stuff that you can add to the chart.
Because those are more data points, which makes your probabilities higher.
Right.
So they are important. But let's just say you just want to go to the most basic version of this. That's what we're looking at.
Yep, exactly. And then once we get back above that line, we get support, right? Every time we consolidate down to it, we get support until this break right here in 2018. Came down, got below it, spent most of this time below the line, which is bearish, right? Once you hit it, you want to get back above it. It couldn't do it, so it did another leg down. And that's what you kind of want to try to avoid. Once it got back above it again, support until COVID crash, right? So it's the same exact thing as the monthly. It's just weekly. And the 50-week moving average works pretty well on a weekly basis. So if we go fast forward to where we are today, once we broke down through it, it comes up and now acts as resistance, and now we just poked back above that 50-week moving average line. Okay.
And that's when you really got to be paying attention. Yeah. Is it a trend change, a long-term trend change, or is it a short-term trend change?
Right. And those are the lines, we call them lines in the sand. Like, as long as we can stay above that line, we can, if we look back here, once we get above that line, if we keep getting support there, the price it's going higher. You want to see the trend of the blue line start moving higher, and then you're making money. So obviously in 2002, the trend of the blue line is down, right? Okay, so 50-week moving average line works pretty well. If you go forward to a 5-year daily, okay, so now each tick is a day instead of a week, and it's a 50-day moving average line. And this is where it turns from a science to an art, basically. You want to pick a moving average line, and they're different. I mean, I use a bunch of different moving average lines, but it depends on the market or the stock, the ETF, whatever you're looking at, right? You can kind of see here that the 50-day moving average line on a 5-year chart isn't really that useful. Basically, we came up here in 2019, got above it, got support, broke support, and then it turned right back around and got back above it again, broke support. Maybe you would have thought it was going to go down here, but it didn't. It kept support. So if you're looking at a chart and you put a trend line on there, and the trend line tends to bisect the price, right? That just like here in 22, the trend line tended to, or the moving average line tended to bisect price, and it's not very helpful, because if you get out here, that was good. If you got back in here, that's not so good, right? Because you missed the bottom, and by the time it rolled over and crossed back down, you lost, right? And you probably got out on the gap down. So you have to pick moving average lines that are consistent with the price chart that you're looking at. Okay, so basically I'm saying the 50-day moving average on its own is not a great moving average line to look at. by itself. So the ones I tend to use right now are the 20-day exponential moving average line, which just means that the formula gives more emphasis on more recent price. So it's a 20-day moving average line, but each newer day gets more value in the algorithm than the older days. So if you do that, you can kind of see it's on a daily basis. So once we broke down through that 20-day moving average line, we came up and hit resistance and didn't have a whole lot of overshoot, right? When we got down to a bottom here, it got above that line, and we had a lot of time above that line before it came down and got below it. So you would have made this gain right here, right? Even if you got in here and got out there, you would have made a gain. You wouldn't have had a loss. And then if you got out here, you would have stayed out for this whole, at least this part. Could you have gotten back in here and gotten out there? It would have been a flat, and you would have avoided this loss. So what I'm basically saying is you need to play with the trend lines, and you can go in there in stock charts and do, 5 day, 6 day, 7 day. Every time you adjust the line a little bit, you can, it'll move the line away from or towards the price, and you can get it to a place that makes sense, right? So this is the red line is the 200-day moving average line. And on this, what is this, year and a half, say, we got back above the 200-day, didn't stay there very long, acted as resistance, and now it's above both the 20-day and the 200-day. Okay. So you have to decide whether or not you want to look at monthly charts, weekly charts, or daily charts, and which ones are you going to use to make reallocation decisions is kind of what it comes down to. Okay, so that's moving average lines and how you would use them for support and resistance, right? Last time here in this section, if it's above the blue line, you want to be in the stock funds. But as it's coming up to the 200-day moving average, you're concerned about resistance there. Okay, so if I'm looking at it and I'm just using these two tools, right, the 200-day and the 20-day, I get in right there. It comes down, finds support at that line, great, moves up, consolidates, great, comes up, and as it's approaching that 200-day moving average line, I'm looking at other indicators to see if momentum is weakening as it approaches that point, right? So these are other things that we look at. But again, if we're just looking at these two tools, when we got this gap down right here, after it hit resistance at that 200-day moving average line, you could give it another day, but that gap down at resistance is telling you the next move is lower. And we're in an overall bear market trend anyway. So this was a pretty easy, and a lot of people made a lot of money shorting the market at that point. Not in TSP, but that's how you would do it. Okay. I think that's it for moving average lines and support and resistance. Trend lines. Trend lines are something that you draw. They're not moving averages. They're just something that you draw. So all I did was pull up a chart going back to COVID. And if the market's in an uptrend, all you're doing is connecting the significant lows all the way along. And that gives you a trend. Okay. It's not an algorithm. You're literally drawing the line. But you can see that price tends to find support along that trend line over time. I mean, this is a pretty long trend line. And then once it breaks it, something's going on, right? And so then you would draw the trend line to the downside, which is what we did. And then when it breaks it to the upside here, something's going on, which it did. Now, it didn't go to new highs, but we had a pretty good run there in the summertime up to the August high. And then it rolled over. So now it gives us points to draw the trend line that way. So you're just drawing them yourself. So that's what an uptrend line looks like. A downtrend line, which we've been talking about here for months because this is where we are. So we're at the top here in January 22. We come down, we come up. Obviously, there was no line here then. There was the 200-day moving average line. But this point gave us, once it rolled over, it gave us an ability to draw a line. And you could extend it out as far as you want. And then as price rolls over, finds a bottom, you're expecting it to come up and hit that trend line again, which it virtually does. Comes down to new lows, comes up, hits it again. Right? So these are the areas where if you're in a brokerage window, you're shorting the market at that point. So why would you do it at that point? Because every time it's hit that trend line previously, it's rolled over. And so what that enables you to do is say, okay, the market comes up and tags my trend line right there. I'm going to short the market. If it goes against me, as soon as it closes above the line, it went against me. And so what does that mean? If I shorted it right there and the price came up to here, I lost this amount. Right? That's my risk. But the potential gain is that if it kept going lower because I'm shorting it, every time it did hit that, it went to new lows. Right? So you're betting that it's going to new lows again. But your risk is very small because if it gets up here, you get out. And it's the same thing on the long side. Right? If you're back here, let's take that point right there. If price comes down and consolidates to that trend line, you buy it, right? Because every other time back here, it hit that trend line and found support. So you buy it here. If it closes down here, you sell it. So you lost this little bit. But the expectation is the trend line stays in place and the market keeps going higher. So it's knowing where you are with respect to the trend line is what enables you to get in to minimize downside risk, right? That's the most important thing is being able to see a way, making reallocation decisions at a time when you have a quantified risk is probably the most important thing for me. All right. So that's moving average lines, trend lines, candlesticks versus line charts. So same charts, about a year and a half of the C fund. These are candlesticks, okay? So each one of these, it's either a white rectangle or a red rectangle, okay? So real quick, what candlesticks means
and you'll see them, and just so people don't get confused, you'll see them in different colors if you're in different platforms, right? So sometimes it's black and white, sometimes it's red and white. You can choose that.
Yep.
So it's customizing it, but generally 2 colors.
Yep.
That's the takeaway.
Yep,
right?
2 colors, and it tells you a ton of information.
A lot in just one little piece of thing.
One day, so each one of these is 1 day of price movement, right? If we look at, let's say this candle right here, okay, this big red candle right there. So what happened on that day? The market opened at the top of the rectangle that's in red. It closed at the bottom of the rectangle. Okay? And it had a high throughout the day at the top of the wick. Okay? It's full, it's red and fully drawn in. It's fully drawn in, and it's red because it was a down day. If it was white, like if we look at this one, right? The market opened at the bottom of the rectangle and closed at the top of the rectangle. And there were no wicks.
Because it's an up day.
It's an up day, and it opened at the bottom of the day's trading range and closed at the top of the day's trading range. Okay? So that's how the body works. The wick, say this one right here. Okay? The market opens at the bottom of the white rectangle. It closes at the top of the white rectangle. So if you just looked at the opening and closing price, you don't think nothing really happened that day.
It was
The market
a pretty
didn't move
boring
very
day.
much. It was a boring day, right?
Yeah.
There was a giant intraday move all the way down to here. That was the lowest price of the day. Okay, and then it came back up at some point in the day and closed above the opening.
Yeah, and that's why you'll see day traders use these, like, this is their golden,
Yep.
Thanks, because there's so much information in that one day, and then you can even go deeper, right? And you've got minute ones,
sure,
hour ones,
yep.
right? And so there's just so much information in whatever time frame you decide, right?
Right.
Those could be weekly.
Yep, definitely.
Right, and so there's a lot of information in one little piece of data, right? And that's useful to see like how much is actually going on in the market versus like what the open close was, because that's only part of the story, right? But because we're in TSP, like we don't really have candlesticks in the C fund. That's why we have to use S&P 500 to get the candlesticks. That's sometimes I see people that get a little confused about that. Like, how do you get these candlesticks for the C fund? Well, we have to use the S&P 500.
Yeah.
And the C fund would just be a open and close. It would be a block.
On a day, yes. Yeah. Because it's a net asset value. You can't trade intraday in the C fund.
Yep.
So on a daily basis, you only get one data point. On a weekly basis, you get 5. Mm-hmm. So you can get candlesticks on a weekly chart or a monthly chart. Oh, yeah. You just can't get it on a daily chart.
Right.
Okay, so
that'd be intra-weekly.
Intra-week. Yeah, that's exactly right. So one more thing to point out about the wicks. It's not 100%, right? But if you get a daily wick that looks something like that, where the price, there's basically no rectangle in there, right? The price opened and closed at the same level, right? But it ran up during the day and then came all the way back down to where it opened, right? That's a bearish reversal candle, okay? So if you have big wicks on the upside, it generally means the market's going to go down from there, okay? And the opposite is true. This was a day or two early, but this is a huge bullish reversal. It implies that the market's going to keep going higher from there. This looks much better on a weekly, but this was the bottom day in October, and we had a big reversal off of, it hit right at 3,500 was the low for the day, and reversed and closed right there just below 3,600, and then kept moving higher. Same thing here. 3 really good bullish wicks, and then the market kept going, right? So candlesticks definitely is our preferred kind of chart style. This is the same chart with it's just a daily close. So all it is a line. So whatever the closing price of the day is, each closing price is connected, and that's how you get the line. And so you don't see any of the wicks, and so it takes away some of the noise in the chart, which can be a good thing. It doesn't matter. One of the questions was, do you use the wick? If I was going to draw a trend line, would I start at the top of the wick and connect the tops of the wicks? You can definitely do that to draw a trend line. You could connect the body, right? You basically play around with it. It's not an exact science. You play around with it and see what kind of works for you. You could do the same thing on a closing basis, right? Your initial trend line would come down and it would have cut off this part. So you would adjust the trend line and connect the major highs and lows, and it puts you, more or less in the same place. But that's kind of how you would do it. Okay. Chart types. So if you go, you don't need a subscription to it or anything. If you go to stockcharts.com and you put in $SPX in the box, and you scroll down to chart attributes, okay? You hit that menu in type. So this is chart type. And if you scroll all the way to the bottom, there's like 25 different chart types. Go all the way to the bottom, you get Elder Impulse System, okay? And so this is a chart of the S&P 500 using this Elder Impulse System. So this chart is a line chart. You would go to the same place and you would select line, and this is what you would get. This chart is candlestick, okay? These are ways of displaying price. Candlesticks, lines are ways of displaying price. The Elder Impulse System is not, it takes a lot more things into account than just price. It's not just a way of displaying price. It actually includes a whole bunch of other things. So Elder Impulse System indicator, it identifies transitions where a trend speeds up or slows down. That's what it's trying to do. It's not, it is showing you price, but the colors are identifying when the trend is increasing in one direction or the other. So the impulse system is based on two indicators, an exponential moving average, right, which was the blue lines that we looked at, exponential moving average over a number of days, and the MACD histogram, which is one of the technical indicators that we always that we show quite a bit. So this system, it's a system. It's not just a way of showing price. It's actually incorporating a bunch of technical indicators into the one chart. Okay, so while it's listed in the chart type, it's listed in chart type. It's not. It's more of a system than just a way of displaying price. Okay. So now that we know that,
it bakes in MACD.
It bakes in MACD. Yeah. So now that we know that, here's what we're looking at, right? When you don't need a moving average line because it's in there. It's already part of it. You don't need a MACD because it's part of it. So it gives you this color-coded thing where if you're green, you're above the moving average line, which is baked in, and momentum is improving. Okay, when it's blue, it's kind of transitioning. When it's red, it's going down. So you could use this as a color-coded chart to get in and out of the market, right?
So this seems to me, again, I always play kind of the dumb guy, which is easy for me. When I look at that, I think that that may not be where you start as a beginner. You have to understand MACD and moving averages and a lot of things. You have to already understand them and feel comfortable with them. Then that may speak to you in a way of like, oh, I got all that in one. Right. Then I don't have to look at all these different things. I can see it all at once. But you have to be able to see that. If that system, and I'm not just picking on this one, I'm not picking on it at all. But what I'm saying is I always try to bring it back to the beginner stage where it's like, if you look at that and it speaks to you, that's probably a phenomenal tool, right? If it doesn't speak to you, and that goes back all the way back to all those things Jerry just showed you when he showed you candlesticks. Candlesticks don't speak to me the way they do to Jerry, because Jerry's been doing this for decades, and I've been doing it for about a decade, maybe, right? If that. And so they don't speak to me quite as much. And so I use them, but, moving averages and trend lines speak way more to me because I've bought into the thesis of long-term kind of, management of it, and I'm not looking to day trade or even week trade, really. I want long-term for my retirement account, and so that puts me in a place where I feel comfortable, and I'm like, hey, that's good enough for me. Now, if I was willing to really dig into this, like when you're learning language, and at some point the language, you can't just think in that language. Once you get to the point where you're like, you think in a sentence of that language and you can say it and you're carrying on a conversation, that's what's going on there. And that chart, to me, that's like you know French really well. Right? And you're good with all of the you guys get the analogy. I don't have to keep going with it. But that's how I look at that. And I think it's super useful if it speaks to you.
The thing that is interesting about this from my perspective, like I didn't know about the Elder Impulse system. And so I dug into a little bit, and it's great. It's almost like driving a car and not understanding how the car works, right? Like I'm looking at this chart and I'm going, okay, I understand the exponential moving average line is baked into the price, into the color codes here, and that the MACD histogram is also. And so when you get to a place like any of these transition areas, the blue lines, if you didn't want to deal with all this stuff, you would just say, okay, when it's green, I'm going to be in the stock funds. When it's blue, I'm going to get out, and I'm going to stay out during the red, and I'm going to get back in, at the transition or when it turns green.
Green is in,
green is good, red is out. Yeah, you can do that. The problem becomes something like this. Like when the transition is not indicating that you should be looking to get out, but look is indicating you should be looking to buy more. And the way you would know that is because of what's behind this that you don't see, because they incorporate it all into the chart.
Right. Yeah, it would be hard to look at. I see what you're saying. Like, it would be hard to look at that and see a larger trend change. I mean, you'd almost, to me, I would look at that and go, "Oh, I'm going to have to give it another day or week." Is this a weekly?
No, it's a day.
Yeah, I'd have to give it another day.
So the thing is, if you pull that apart, by looking at it, I would say that the price is probably above the exponential moving average line, but the histogram is probably starting to roll over, which is probably why they get the blue versus the green.
Right.
And then price firmed up and the histograms, turned the other way. But I would look at the histogram and look at, okay, did it cross the RSI, CCI?
Well, that would be no different than what you kind of do now when you really break out. Like if you guys read our newsletter, Jerry has the full chart, not just what we show on the podcast, meaning he's going to have all the other data points. Right. And then so all you do is throw MACD down below that chart, and you could see it immediately, right? So you wouldn't have to be looking at it, but it's there. And so you would just go pop down on the bottom and go, oh, I see what's going on. Right. So that would be an easy thing, right, to do. So I think it wouldn't be like, oh, the system doesn't work on that day. It's more like, no, I need another data point.
Right.
Or I need to see that data point a little better.
Yeah, it works. I mean, this isn't a bad, and it's a system.
I like it, actually.
It is a pretty good system.
Well, where I like it, I don't know so much that I like it for TSP, but I would like it for other things to be able to see how this plays out as a tool to be able to make some quick decisions on, if I was trading, not day trading, because when I think of day trading, I think of trading them multiple times in the day, intraday, and you're never going to catch me doing it. I don't have time for that, right? I don't have the patience for that. That's a better way to say it. But intra-weekly, like that would be fun to play with, to see like, oh, well, could I use that on some different things? It's interesting.
Yeah, it is. It's pretty good. I mean, and you can see this is actually a bar chart. This is the default that they use. So we talked about candlesticks, talked about a line chart. This is actually a bar chart, and all you get on a bar chart is, say, the opening price is the little tick on the left, the closing price is the little tick on the right, and then this is what happened within the day. That's the range.
That's the range.
So that's all you get. I mean, bar chart gives you more information than a line chart, but not as much as a candlestick.
Right. It's kind of in between, right? It's for people that understand a line chart really well, and then you just add a little bit more information.
Yeah.
And then if you want to go crazy, then you pull out the
candlestick. Yeah. But see, so this is actually pretty good because you can see this October low that day. You have that wick because you can see where the price closed above the intraday low, and then the next day was blue. So it went from red to blue. So that's a really good indication that you're probably going higher from there. I mean, this is another good one. You got a red here, price is above it, and you're consolidating in blue for a while. Once you break this down trend line, you're good. So it's a pretty good system. It is. I like it. Okay. There are a ton of good systems out there. You just got to find one that speaks to you. Okay, TSP fund charts. So this is the chart we always do. Basically 3 years. I just go back far enough to be able to have COVID in the mix. Once we got back above that, I used the 20-week exponential moving average line. Once we got back above there, we found support all the way along until January, and that was the beginning of the problems in 2022. So in the big picture, you want to be in stock funds when price is above the blue line, right? You want to be out of the stock funds when price is below the blue line. And here we are right now, right? We've been above that blue line for the past 2 weeks. So I did this chart as of yesterday's closing price. So today I think the market's probably going to be down a little bit, but it's certainly not going to take us back down below that trend line or below that moving average line. So you can give it another week, another day, whatever you want to do. You could wait until we get back above the August high, if that makes you more comfortable. The further price gets from the moving average line, the more your risk is.
Yeah.
So I get this question all the time. I didn't make the move yesterday. Should I do it today? If you don't do it on the day that the alert comes out, the only thing that happens is your risk increases.
Right. And there's nothing we can do about that. And we don't know your risk tolerance.
Right.
And we don't know your personal situation. So we're never going to answer that question other than answer it the way you just did, right? And so I understand the question. I totally understand it. It's usually from new folks, and because they're like, "Oh my God, what do I do?" Because you come into this out of sync, right? If you were even in sync at all, or had a plan, whatever. And so in the big picture, right? In the big picture, I don't think it matters that much. I would say normally, if I don't rarely ever give any advice, but if I was to give it to myself in this situation, I would say to myself, okay, if I'm out of the market, I'm probably just going to stay out a little bit until I get a few days of the trend. Yes, my risk is increasing, but I'm not going to only look at this, right? If you're listening to us, then go look at the MACD, go look at the RSI, go look at those other indicators, and if you don't know what any of that stuff is, you just sit still, right? Or
learn about it.
Just say, okay, is it 3 days ago? Is it a week ago that they did that? Like, as you hear us talking about, the risk increases, but then again, the trend might be changing a little bit. There's too many factors to answer that question. And the answer is always, I don't know, because this is a model that we do, right? So this model that we do, we would have gotten in back into the stock funds, right? Which is the CNS. Yeah. We would have got back into stock funds at that point. The answer after that is we're in them, so we don't know. Like, again, it's your risk tolerance. So you got to look at that and think to yourself, I don't know, maybe I wait until it crosses, you can draw on it there, it crosses that August high.
Sure.
Maybe that's your next line in the sand. Yeah. So draw a line there.
Yeah. I mean, we talked, on the newsletter, we talked quite a bit about this level right here being taken out.
Yeah, very important level. Two things happened. Right? We went over the moving average. Right? And then we also crossed that previous high. The next line in the sand. So I guess this is probably a better answer, right? Scratch everything I said, but it is about personal risk tolerance, right? And so if you say, okay, well, where's my next line in the sand? That next line in the sand is that line. So if you draw a line all the way across, so do yourself and then another one above that August high, right? So we already crossed that line in the sand. The only next viable line in the sand for a decision point is that next higher line, right?
Sure.
Yeah. And so if you're just, again, taking just that into consideration, if you come in and you're like, oh, what do I do? Draw yourself a line, right?
Yeah, right.
Draw yourself a line, like we're doing on there, and look at it and go, okay, well, there's my risk. If I got in there, the biggest risk I have is that it goes back down to, you already erased the line, sorry.
Yeah, well, that is true. If it comes back down and gets below that line.
Yeah, and then draw the other line again. So, because you've done this several times for me, and I like it. So my risk is that I go up to that next line and come back down.
Yep.
That is probably the largest risk right that moment, right? Is that it goes up to that line and comes back down. So if you don't want to take that risk, stay out till it passes that line, then jump in.
Right.
But either way, that's your next line in the sand. And, we got to find a little clip. We may have to just pull this clip out and just give that to people when they ask that question, because that's the answer. That's the answer is, okay, you missed our line in the sand.
Right.
Now you got to go find yourself one to get back into sync with us. Yeah. And there are a lot of people, more and more now, that don't necessarily make their moves exactly when we do, because they've drawn out their lines in the sand. Yep. They like their methodology that works. And I would argue that, as long as you're still in the same kind of thesis, meaning, number one, don't lose money, be in when the trend is up, being out when the trend is down, like that's a very simplified version of the methodology, but it is that. And so if you're staying within that same rule set and you're doing it slightly different, but we're all coming out to basically the same performance, then there's nothing wrong with it, because you found something that speaks to you.
Right. People, there's a ton. There's like 50 indicators that you could put. I tend to use 3. There are people that use Bollinger Bands, and
they might make you in or out a little bit left or right, and it's probably not going to make that big a difference.
No, if long term, right? Long term, yeah. And if you're making the most important thing is to do the next step. So if you decide you're going to make you think the market's moving higher, you're going to get into the stock funds. Take the next step and say, okay, what if I'm wrong? How will I know when I'm wrong? And you draw that line, and then you don't have to worry about it.
Yeah.
If it keeps going up, great. If it rolls over and crosses that line, you get out. That's it. Yep. And you make the next thing. Real quick, I put out a thing on Facebook a few days ago. What I'm looking at right now is we're in a downtrend, right? A long-term downtrend. You could argue, because you can connect these lines, that we're in the beginning of a new bull market. That might be. But before we get out here, we have to get past this ABC, right? A, B, C. So if the length of this line equals the length of this line, you're right there at about 43.50. And it's about the same. It's a little bit above that August high. So here's RSI, right? If RSI doesn't get much higher and starts rolling over as price is going up to that 4,300 level, I'm very skeptical that we're going to keep moving higher. I'm much more likely to lock in my gains there in expectation of the market to roll over. And a lot of it you're seeing from the technical indicators. And what should happen on this is if you get up here to 4,300, it starts getting blue if it's going to roll over. That's what would happen. Okay. So that is the C fund. S fund, kind of a no-brainer at this point. If you're not already in the S fund, you missed a huge week. It doesn't really matter. It's actually a good thing because there's a lot of strength in that candle. We opened at the bottom. You can just barely see a little wick below it, and we're probably as of Thursday's close, we were pretty much right at the top for the week. Super strong. We're well above 50 on RSI. So, and like we say, you want to be in the stock funds when we're above that blue line, and we are certainly above that blue line right now. And we want it to be supported, of course, by the technical indicators. I fund, monster breakout back here in November. If you're a subscriber to the site, we got in on some of the I fund and the F fund move back then. Consolidated for a couple of days, didn't even make it back down to that 20-day moving average line, and then exploded off again. RSI almost overbought, looking super strong. iFund could very well outperform the CNS funds going forward for years, actually. That's a different story. But obviously from this chart, the iFund is looking super strong. F fund had a pretty big rally off that October low. We got a pretty good buy trigger there when it crossed that 20-week moving average line, came down, consolidated, had 1 week below it, and then kept on moving higher. There's a lot less risk in the F fund. It's unfortunately still moving in the same direction. So throughout 2022, stock funds and the F fund we're going down, and now going into 23, ever since the October low, the F fund and the stock funds are still moving higher. At some point, that's gonna change. If the stocks roll over, the F fund should move higher.
And that's what we're hoping for, if we hope at all, is that the normal comes back and there's a divergence.
Yep.
And then that's a great sign, because we do want to get back to normal.
Yeah.
With respect to the way that these different indexes kind of relate to each other. Yep. Because most people won't think that's not most people, but some people look at that and don't see the significance of the fact that the F fund and the C fund are going together. Yeah. That's not a good thing.
No,
that's not a good thing, because that's like it's raining cats and dogs, and the world's different. Like, it's not a good thing.
Yeah, I mean, we could talk for hours about the things that are going on in the world and what should affect the market, and the price of the dollar, rates going up and down, the fact that the Fed is pushing rates higher, but in reality the bond market's pushing the actual interest rates low. Yield is moving opposite to what the Fed is doing. That's why I put up this picture on Facebook yesterday, the day before, about had a big bull and had Powell standing there in front of it, and I mean, every time the Fed says, we're going to keep raising rates until they call it financial conditions tighten. Financial conditions tightening is code for until the market comes down, and so there's this standoff between the market and the Fed. And if you spend your time listening to that stuff and then try to make decisions based on that, you are good luck. Good luck. All right.
Questions.
That's a pretty good one. A lot of good stuff in there.
I like it, man. I like those learning. I like the ones that we're doing a lot of learning in it more than the others. But, we can't do that all the time because it would be the same. It would be kind of repetitive. Yeah. But no, I love that one.
No, I appreciate the
question was great.
The question was great. Yeah.
You guys have no idea how useful it is when you give us kind of feedback like that because, we do this every week. We don't do interviews, so that's how most podcasts are. Yeah. So you go find somebody to interview, and that keeps your content going. Yeah, it's just Jerry and I talking about the market,
right.
And sometimes there's only so much to talk about. Right. And honestly, that's not as educational as it is asking these kind of questions. Is give us something to dig into. Yep. Put together a little educational piece. You got a mini class on technical analysis in the last 40 minutes. Yeah. And that's hard to find nowadays, right? Yeah. And so, no, it was great. If you have any questions, though, put it in the comment section wherever you find this video. If there is no comment section, you can always send us an email at support@growmytsp.com. The customer service folks will send it over to us if need be. But, hey, we love your questions, love your feedback, and it really helps us kind of see what topics are on your mind.
Absolutely.
All right, guys. I hope you have a great week. Hopefully it's warm where you are because it's not here.